Welcome back to our discussion of tax credits in Chapter 9. We're going to start here with the foreign tax credit. This credit is available for taxpayers who paid foreign income tax. The credit is equal to the amount of foreign taxes that are paid, but are limited to the portion of U.S. tax liability that's attributable to foreign income. The calculation to calculate the portion of U.S. income tax liability that's attributable to the foreign income is the foreign source taxable income divided by worldwide taxable income multiplied by the U.S. income tax liability before the foreign tax, which equals the U.S. income tax attributable to foreign income. So this is the foreign tax credit limitation. The taxpayer may also choose to deduct foreign taxes as an itemized deduction. However, in most cases, it is more advantageous for the taxpayer to take the tax credit instead of itemizing it. So let's take a look at an example. Joy has $63,000 of worldwide taxable income, which includes $8,000 of taxable income from New Zealand. She paid $2,500 in foreign income taxes, and her U.S. tax liability is $17,640. So we need to calculate Joy's foreign tax credit. So we're going to take her taxable income from New Zealand, $8,000, divide that by her total worldwide taxable income of $63,000. We're going to multiply that times her U.S. tax liability of $17,640. So her limit should be limited to $2,240. Since this amount is less than the foreign tax paid of $2,500, the credit that she would qualify for would be $2,240. So next we're going to talk about the child tax credit. This credit is provided for taxpayers with children under the age of 17. The child must be a U.S. citizen or resident and also must be younger than the person claiming the credit and be unmarried. The credit for each child is $2,000. This is up from the new tax law. The credit is phased out for AGI over certain amounts. The credit is refundable up to $1,400 per child. And there is a $500 non-refundable credit provided for qualifying dependents other than children or children that are over the age of 17. The phase-out begins at AGI of $400,000 for married filing jointly and $200,000 for all other taxpayers. This phase-out period was drastically increased with the new tax law. The credit is reduced to $50 for each $1,000 or fraction thereof of AGI in excess of the above amounts. So if we have a single taxpayer who has AGI of $217,000 and has one qualifying child, his or her tax credit would be limited to $1,150, since we need to decrease it by $50 for each $1,000 of AGI over $200,000. The $2,000 child tax credit would be reduced by $850. Although this tax credit is generally non-refundable, this credit could provide a refund at certain earned income levels if the taxpayer qualifies. A Form 8812 must be attached to claim that credit. So the child tax credit is refundable up to $1,400 at certain income levels. So let's take a look at an example. Pat and Lisa have two qualifying children, age 11 and 8, and file jointly. Their AGI is $112. So what amount of child tax credits can they claim after their AGI limitation is considered? So their child tax credit would be $2,000 per child, or $4,000 total. The AGI limitation does not apply since they're married filing jointly, and their AGI is less than $400,000. So next we're going to talk about the Retirement Savings Contributions Credit. This credit is available for taxpayers who make contributions to certain qualified retirement plans. These can be made to IRAs, Roth IRAs, 401ks, 403bs, 457 simple or SEP plans, or other qualified retirement plans. The credit is based on a percentage of the contributions that are made, and there is a maximum amount of contributions for the credit purposes is $2,000 per person. The percentage that is used to calculate the credit depends on the filing status of the taxpayer and their modified AGI. So the filing status, AGI limits, and percentages for the retirement savings contributions credit are listed below. So for joint filers, for income earners between 0 and 38,000, they are at a 50% savings credit amount on savings of $2,000 or less. Between 38,000 and 41, the percentage drops down to 20%. For 41 to $63,000, you're at 10%. And for joint filers over 63, head of household over $47,250, and others over $31,500, the credit does not apply since that percentage is 0. So let's take a look at a couple examples. Enrique and Lupe have AGI of $52,000 and are married filing jointly, and they contributed $1,500 during the year to a qualified retirement plan for Enrique. How much is their retirement savings contributions credit? Well, if we go back to the chart, they have AGI married filing jointly at 52, so they would fall in the 10% credit amount. So their credit would be $150. Roger is a head of household taxpayer with AGI of $26,000. He made a $2,200 contribution. How much is his retirement savings contributions credit? So his contribution is going to be limited to $2,000 for the credit, and his AGI of 26 falls into the head of household, so he falls into the 50% category. So $1,000 would be his retirement savings contributions credit. So next we're going to talk about the adoption tax credit. This credit is available for 100% of qualified adoption expenses that are paid by the taxpayer. The credit is available up to $13,810 per child that's adopted. If married, the taxpayers must generally file jointly to take the tax credit. The credit phase-out begins at AGI above $203,540 and is phased out for AGI above $243,540. For AGI that's within that phase-out range, the tentative credit is multiplied by the following fraction: $247,140 minus their modified adjusted gross income divided by 40,000. So let's look at an example. Adam and Michelle incurred the following expenses with the adoption of their infant daughter, which was finalized in 2018. In 2017, they had $10,500 worth of costs. In 2018 was $3,950. If their 2008 modified AGI is $120,000, how much can they claim in 2017, and how about 2018? So in 2017, the adoption was not finalized yet, so they can't deduct anything. In 2018, they can start deducting their total costs since that adoption was finalized. However, that credit is limited to the maximum of $810. So next we're going to talk about the Earned Income Tax Credit. This credit is available for working taxpayers who are economically disadvantaged. The EIC is a refundable tax credit and is based on the filing status, number of qualifying children, and earned income amounts. Earned income includes amounts from wages, salaries, tips, and earnings from self-employment, minus 1/2 of the self-employment taxes. To be eligible for the credit, the taxpayer must either have a qualifying child or meet certain criteria. The credit can completely phase out at certain earned income levels, and certain types of income, mostly investment income in excess of $3,500, will cause the taxpayer to become ineligible for the credit. All taxpayers are required to either have health insurance, qualify for an exemption, or make a shared responsibility payment with their tax return. The responsibility payment is covered in Chapter 1. If the taxpayer purchased insurance in the marketplace, a premium tax credit may be available. The credit is available for households with income between 100 and 400% of the federal poverty line for their family size. The premium tax credit is the lesser of the insurance premium through the market, or the premium for the applicable second lowest cost plan minus the taxpayer's contribution amount. The information that's needed to calculate this credit is provided by the marketplace on Form 1095A. So also this premium tax credit, due to the dissolution of the shared responsibility payment for 2019, will be going away next year.